Hi there, it's Friday the 26th of June 2020. I'm Steve Towers. Welcome to ITB. Let's get started. US Treasury Secretary Mnuchin's letter on the 12th of June to the finance ministers of France, Italy, Spain and the UK has now become public, and it does make interesting reading. Firstly, it's clear that the US government is merely calling for a pause in negotiations on Pillar 1. Mnuchin says this: the United States does not believe 2020 is a suitable time to be conducting such negotiations. The amounts involved with Pillar 1 and digital services taxes are modest compared with the economic challenges facing the world's economies. Attempting to rush such difficult negotiations is a distraction from far more important matters. The United States therefore calls upon the OECD to pause discussions of Pillar 1 with a view towards resuming later this year, when they can more appropriately receive the attention they require. We hope that later in 2020 an agreement on Pillar 1 can be reached. But there was also a threat. Meanwhile, the United States remains opposed to digital services taxes and similar unilateral measures. As we have repeatedly said, if countries choose to collect or adopt such taxes, the United States will respond with appropriate commensurate measures. Also, as I reported last week, it's clear that good progress is being made on Pillar 2. Mnuchin says this: with respect to Pillar 2, discussions at the OECD regarding a global minimum tax have progressed more rapidly and are much closer to an agreement. Because an agreement on Pillar 2 does not present the same challenges as Pillar 1, the United States fully supports bringing those negotiations to a successful conclusion this year. The 4 European finance ministers have responded with their own letter. In regard to the timetable for negotiations of Pillar 1, the letter pushes back on the idea of a pause, but it does offer some concession to the US. It says this: therefore, we believe that postponing our work and not addressing these challenges would constitute a collective failure. Indeed, we think it feasible to concretely deliver a solution to a 2020 timetable in line with the G20 mandate. Building on the outcomes of technical work already advanced at the OECD, we believe that a phased approach, initially focused on automated digital services, would considerably ease the task of achieving a consensus-based solution and make a political agreement within reach this year. And the letter responds to the US threat to impose tariffs. On the contrary, suggesting that the United States could retaliate against national fiscal policy decisions would be neither in the economic interest of the United States and Europe, nor consistent with the quality of relations between allies. We share your desire to strengthen our unity in the face of the unprecedented economic crisis, but this cannot be achieved through threats and sanctions. A copy of these 2 letters is available on our website or app. The US Trade Representative has requested public comments in regard to the imposition of additional tariffs on imports from France, Germany, Spain and the UK in response to the EU Airbus subsidies. A copy of the USTR's request is available on our website or app. The free trade agreement between the EU and Vietnam will enter into force on the 1st of August 2020. And the OECD has released a working paper on carbon pricing. A copy of the paper is available on our website or app. In Australia, the tax authorities have issued 2 items of guidance on the transfer pricing impact of COVID-19. The guidance deals with documentation and contractual issues. Commentators have noted that it does not deal with restructuring or termination of related party arrangements due to COVID-19. A copy of the 2 items of guidance is available on our website or app. Also in Australia, a tribunal has decided a case in regard to whether bitcoins constitute foreign currency for Australian income tax purposes. The tribunal decided that they do not. A copy of this case is available on our website or app. In Hong Kong, the tax incentives for the shipping industry, which were proposed by the government earlier this year, have been enacted as an ordinance. There are 2 key incentives. Firstly, the profits tax rate on the profits of ship lessors carrying on ship leasing activities is 0%. And secondly, the profits tax rate on the profits of ship leasing managers providing ship leasing management activities is either 0% or 8.25%. A copy of the ordinance is available on our website or app. In Malaysia, the tax authorities have issued guidance in the form of frequently asked questions on the impact of COVID-19 on procedures for advanced pricing agreements. A copy of the guidance is available on our website or app. In Taiwan, the government has issued guidance on the withholding tax treatment under domestic law of outbound payments of technical service fees and royalties for the use of intellectual property. A copy of the guidance is available on our website or app. In Thailand, the government has published a royal decree in regard to the 10% incentive income tax rate for qualifying companies which carry on business operations in any of 10 special economic zones. The 10% tax rate applies for 10 years. A copy of the royal decree is available on our website or app. In Vietnam, the corporate income tax rate for 2020 has been reduced by 30% for SMEs. To qualify for the rate reduction, a company must have annual sales below 200 billion Vietnamese dong, which is about 8.6 million US dollars, and have less than 200 employees. Also in Vietnam, the government has released a draft transfer pricing decree for public comment, with the objective of replacing the existing 2017 decree. The proposed new decree will make 3 important changes. Firstly, the acceptance of commercial databases for comparables and the limitation on the use of secret comparables by the tax authorities. Secondly, a loosening of the restrictions on interest deductibility. The fixed ratio will be increased from 20% to 30% of EBITDA, with the excess interest able to be carried forward for 5 years. And thirdly, the arm's length range will be narrowed by raising the lower limit from the 25th percentile to the 35th percentile. A copy of the draft decree is available on our website or app. And also in Vietnam, it's been reported that the proposed extension of the foreign contractor tax to outbound payments to non-resident e-commerce businesses will be deferred to the 1st of January 2021. As you know, Vietnam's foreign contractor tax is an aggregate of VAT and corporate income tax. In the EU, the European Council summit failed to agree on a number of aspects of the European Commission's proposed EU budget plan, which you'll remember includes several possible sources of additional revenue for the EU. In particular, a number of Eastern European countries, such as Bulgaria, the Czech Republic, Estonia, Lithuania, and Poland, are opposed to the extension of the emissions trading system to the aviation and maritime sectors. The European Council, however, did agree to amend the DAC 6 directive to allow member states an option to defer by up to 6 months the time limits for filing and exchange of information on cross-border tax planning arrangements. You'll remember that political agreement to allow this option was reached earlier this month. The Council representatives also reached a preliminary agreement to defer by 6 months the application of the VAT regime applicable to online companies. It should now commence on the 1st of July 2021. A copy of the Council's press release on these two deferrals is available on our website or app. The European Commission has issued a proposal for Italy to extend its existing VAT split payment system to the 30th of June 2023. A copy of the Commission's proposal is available on our website or app. ECOFIN has issued 2 tax reports. The first is a report on the progress on tax issues achieved during the Croatian presidency, the term of which will end next Tuesday. And the second is an updated report on foreign jurisdictions' preferential tax regimes. A copy of both reports is available on our website or app. In Germany, the government has issued updated guidance on the transitional rules for the reduction in VAT rates for the period from the 1st of July 2020 to the 31st of December 2020. During those 6 months, the standard VAT rate will fall from 19% to 16%, and the reduced VAT rate will fall from 7% to 5%. A copy of the government's guidance is available on our website or app. Italy and Switzerland have signed an agreement in regard to the taxation of cross-border workers in response to COVID-19. This is the latest in a series of similar bilateral agreements between Western European countries. A copy of the Italy-Switzerland agreement is available on our website or app. In the Netherlands, the government has issued 2 new tax decrees, one on mutual agreement procedures and the other on fiscal unity. A copy of both decrees is available on our website or app. Also in the Netherlands, the government has issued a statement that companies receiving government support in regard to the COVID-19 crisis must satisfy 2 tax-related conditions concerning business location and transactions. The 2 conditions focus on share ownership by and interest and royalties paid to entities in low-tax jurisdictions, which means either a jurisdiction with a corporate income tax rate below 9% or a jurisdiction on the EU blacklist. You'll remember that several other European countries have announced similar restrictions. A copy of the government statement is available on our website or app. In Poland, the government has proposed the introduction of the so-called Estonian model for corporate income tax for qualifying SMEs. Under the Estonian model, no income tax is levied on a company's profits unless and until the profits are distributed to shareholders. The proposal is that the Estonian model would be optional for qualifying SMEs effective the 1st of January 2021. There are various conditions to qualify, including these: annual turnover below 50 million zloty, which is about 12.5 million US dollars. And importantly, shares in the company are not owned by another company, whether Polish or foreign. A copy of the government's announcement is available on our website or app. Also in Poland, the government has deferred yet again the introduction of a key part of the country's withholding tax reform. That aspect is the obligation for payers to withhold tax at the domestic rate of 19% or 20%, regardless of possible relief under a double tax treaty or EU directive. This is the fourth time this measure has been deferred. According to the government, it will now commence on the 31st of December 2020. In the Slovak Republic, the government has announced a proposal for the bank levy to be repealed in return for an agreement by the country's banks to significantly increase lending. A copy of the government's announcement is available on our website or app. In Spain, the Supreme Court has decided a curious case in regard to the PE definition in the Spain-Switzerland Treaty. The taxpayer is a Spanish resident company with a branch in Switzerland. The branch conducts a relatively small lending business involving loans to group companies. The Spanish company took the position that the branch was a permanent establishment as defined in Article 5 of the Spain-Switzerland Treaty, and therefore the profits attributable to the branch were exempt from Spanish tax under Article 23 of the treaty. The tax authorities accepted that the branch constituted a fixed place of business under Article 5.1. However, the tax authorities argued that the branch was excluded from PE status by the preparatory or auxiliary character exception. The relevant provision is Article 5.3e, which provides an exception to PE status for the maintenance of a fixed place of business solely for the purpose of advertising, for the supply of information, for scientific research, or for similar activities which have a preparatory or auxiliary character for the enterprise. The Spain-Switzerland Treaty was signed in 1966. The then current version of the OECD Model Treaty, the 1963 edition, had effectively the same provision, which, as you can see, placed the preparatory or auxiliary character exception as an add-on to advertising, the supply of information, and scientific research. The tax authorities appeared to accept, correctly, that if Article 5.3e were interpreted on its face, it would not apply to the branch, because the branch's lending activities were not similar activities to advertising, the supply of information, and scientific research. But the tax authorities put forward a curious argument. First of all, they said that in the next edition of the OECD Model Treaty in 1977, Article 5.3 was materially amended as shown here. As you can see, the references to advertising, the supply of information, and scientific research were omitted. This is the way the paragraph was expressed up to and including the 2014 edition. Also, the OECD commentary from 1977 onwards discussed this paragraph in terms which did not limit its operation to activities which were similar to advertising, the supply of information, and scientific research. And then secondly, the tax authorities said, well, Article 5.3 of the Spain-Switzerland Treaty should be interpreted in accordance with the OECD commentary in 1977 onwards. I should note that the relevant tax years in this case were 2005 to 2008. So effectively, the tax authorities argued that the version of the OECD commentary, which was current in 2005 to 2008, should apply for the interpretation of this paragraph on the basis of a so-called dynamic interpretation of the commentary. As you would expect, the Supreme Court rejected this argument on the simple basis that the OECD commentary in 1977 was directed to the amended version of the paragraph. Although the OECD model treaty had been amended, there had been no amendment to the Spain-Switzerland Treaty. In fact, the argument seems so far-fetched that I'm surprised this case got to the Supreme Court. A copy of this case is available on our website or app. In Tunisia, the tax authorities have issued guidance on the procedures for advanced pricing agreements. A copy of the guidance is available on our website or app. In Saudi Arabia, the tax authorities have issued guidance on the taxation of capital gains from restructuring events. A copy of the guidance is available on our website or app. In the US, the Altera case has ended. The company has been denied its request for a Supreme Court appeal in its case concerning the validity of the 2003 cost-sharing regulations in regard to employee stock compensation. That means that the June 2019 decision of the US Court of Appeals for the Ninth Circuit that the regulations are valid stands. Of course, there are other companies who have an interest in challenging those regs, so we could see more litigation on this issue. And now for this week's single treaty development. All we've had is an announcement by the Zambian government that it will terminate the Mauritius-Zambia Treaty. I'll continue today with the series I started last week in regard to the over 100 court and tribunal cases I've covered in ITB in the first half of 2020. I've divided these cases into 5 topics: double tax treaty issues, transfer pricing, VAT, EU and EEA law, and other domestic tax law issues. Last week I covered the cases on double tax treaty issues. Today I will review the transfer pricing cases. In the first half of 2020, I've covered 9 cases on transfer pricing. Here's the first tranche of 5. Please hit the pause button to study this list. And here's the second tranche of 4 cases. Please hit the pause button to study this list. I have 3 articles for you this week. The first article is called COVID-19 Challenges for the Arm's Length Principle. It's written by Matt Andrew and Richard Collier, and it's published in Tax Notes Today International. And it should be noted that the two authors are senior officials with the OECD, which makes their comments on possible areas or categories for future OECD guidance on the transfer pricing impact of COVID-19 particularly interesting. They identify 5 possible categories. Firstly, all issues that arise as a direct consequence of the sharp and immediate change in market conditions, particularly in the collapse of profitability, including such issues as whether and to what extent limited risk distributors and other fixed margin operators should be insulated from the effects of any sharp downturn in the profits of a business. A second category might address statistical and data-based questions, such as the impact of the crisis on the use of traditional benchmarking sets in any particular business, and specifically the questions of if, when, and how to adjust for material changes in commercial circumstances. A third category is the arm's length treatment of government grants and subsidies that might have been made available as a result of COVID-19. A fourth category is the pandemic's effects on agreements between taxpayers and tax authorities. For example, should advance pricing agreements be modified or suspended because critical APA assumptions are breached in the current environment? And the fifth category is guidance on best practices for administrative topics, including the appropriate steps in documenting any transfer pricing changes made as a result of the COVID-19 crisis. The second article is called Global Transfer Pricing Conference 2020, Transfer Pricing Developments Around the World. It's written by Svetlana Buryak and Mario Riedel, and it's published in the IBFD's International Transfer Pricing Journal. This article is a summary of the key points which were discussed during a global transfer pricing conference at Vienna University in February this year. At that time, no one discussed transfer pricing and COVID-19. But they did discuss these issues, a good recap on significant transfer pricing issues over the last 12 months. Please hit the pause button to study this list. And the third article is called The Futility of Challenging DSTs Under International Law. It's written by Robert Goulder and it's published in Tax Notes Today International. The author considers legal challenges to DSTs under EU law and under WTO multilateral trade agreements. In regard to both, he argues that such challenges will be unsuccessful. In regard to EU law, the main reason he gives is that the ECJ in the recent Tesco and Vodafone cases has effectively shown its willingness to view DSTs as not being discriminatory. And in regard to WTO multilateral trade agreements, he focuses, of course, on the General Agreement on Trade in Services, GATS. He argues that challenges under GATS won't succeed for legal and practical reasons. In regard to legal reasons, he points to several exceptions which could be relied upon by countries which impose DSTs. And from a practical perspective, the lack of an effective appellate body in the WTO means that a successful challenge would be a Pyrrhic victory for the US government. He concludes by noting, ultimately, the fate of DSTs is likely to be settled the same way most trade disputes are, by high-level horse trading. Well, that's the way it is this Friday, the 26th of June, 2020. I'm Steve Towers. Have a great weekend.